Well, let's bring in Jordan Jackson of JPMorgan Asset Management, joins the conversation. It's good to see you again. So are we set up? Are we set up well, or are there still too many risks in your mind?
You know, I think very tactically, there are probably still too many risks in my view. When I say tactically, probably till the next FOMC meeting. I think it still remains to be seen whether the Fed will feel like they've got enough ammo or they can go on pause here. I'm a little bit more in the hawkish camp. I think they'll have enough evidence to maybe go again. When you look at the revisions to the payroll numbers over the last 3 months, the 3-month moving average has jumped up from 150,000 to 266,000. You could almost argue there's been a reacceleration in hiring over the last couple of months, and this is sort of further corroborated by the job openings number, which took a tick higher in August. We'll see how that shakes out in September. Also, when you look at the skew in the FOMC members, just about almost every voting member views core PCE as skewed to the upside from here, where you have no members that see core PCE as skewed to the downside. And then when you look at sort of the broader growth narrative, our numbers are converging with the Atlanta Fed's GDP tracker at now 5%. Our numbers are closer to 4%, but we're still looking at some pretty firm growth numbers. So you put all this together, and then last point I'd make, when you think about the inflation narrative over the next couple of months, autos, I'm a little bit worried about new and used cars with the strikes. You're already at low levels of inventories, and now the strikers add another layer of maybe inflation to the auto sector. So obviously energy as well being a wild card. And so, look, I think they want to put the last nail in the inflation coffin, and that skews me to be that they want to go again before the end of the year.
All right, so there's a lot to get to within that. The first thing I think of, Jordan, is when does good news just become good news? Why can't we accept the fact that we may actually have a soft landing? That, yes, job growth continues to be robust, but at the same time, and you left this out, by the way, wages within that same report came down. That is arguably more important than the headline number of how many jobs were added, is it not?
Well, remember, since the early 1980s, the average wage inflation rate has been about 3%. Over the last 3 years, consumers have enjoyed wage inflation of north of 4%. Now, I certainly acknowledge that it is in a downward trend, but now with where inflation is at today, you're seeing real positive wage growth, particularly amongst lower income consumers. And look, the reality is there's an old adage, a penny saved is a penny earned. Well, for the American consumer, a penny earned is a penny spent. So as long as you, absent a meaningful tick up in the joblessness or tick up in the unemployment rate, I still think consumption remains fairly firm over the next couple of quarters. And I don't think we move back to good news being good news until the Fed is done hiking. And that won't be until next year.